Welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra. Want to increase your financial IQ with today's episode, which is an update on two of the major economic issues that we are tracking here at Elliott Wealth Management. There are also two issues which I've talked about extensively on the show. Additionally, as I meet with clients and we do our work as financial planners, this is something that is key to thinking about where we are today and where we're going economically. So the first thing is inflation. The second thing is interest rates and Federal Reserve activity. So early last week, the inflation numbers came out, and I believe, in my opinion, they were very good. From May of 2022 through May of 2023, the inflation rate was 4%. Now, 4% is higher than the Federal Reserve would like. They are targeting more like 2%. However, last June, it was 9.1%, I think, certainly above 9%. So we've cut it by more than 50%. And this reduction in inflation has definitely defied conventional wisdom. Even at the beginning of this year, even a few months ago, most people thought that inflation would stay higher for longer. But the reality is inflation is coming down faster than a lot of people anticipated. It doesn't come as a surprise to me. You could go back and look at previous episodes. My thesis going into this year actually started late summer last year, was that inflation came upon us faster than expected, and that it would also come down faster than expected. So I think we've done a good job on that front. So as I said, it was 4% May of 2022 versus May of 2023. You may have heard me say on the show before that it was at 8+% in September, and has consistently come down since then. So the Federal Reserve made a lot of mistakes in not acting soon enough to counter inflation. I think they deserve a lot of criticism. I think right now, though, they deserve a lot of credit for bringing down inflation, for acting aggressively to raise interest rates. We're going to talk about that more in a moment. And it seems like they've done this without doing undue harm to the economy. The economy is certainly slowed, but it seems like they are threading the needle and are doing a good job of balancing things out, getting inflation under control without causing too much wreckage. I think I would give them very high grades. I think we are in a position for them to execute a soft landing, which would be defined as getting inflation under control, but also not ruining the economy and doing unnecessary damage to the economy because they are so aggressive that they do a lot of harm. It seems like they're in a position to strike the right balance. We'll call that a soft landing. A few other numbers. When we look at the inflation from April to May, it was 0.1%, which is pretty low. It's another indication that inflation is coming under better and better control. Energy prices are coming down a lot, and that's a big contributor to why the inflation numbers have been improving. The energy prices have consistently come down over the last year plus after a ridiculously bad spike that culminated with Russia invading Ukraine. That really intensified inflation because it drove up energy prices. On a negative note, shelter prices, housing-related costs, if you will, are still going up more than the mainline inflation number. And that's a big element of the consumer price index. And it also means that Americans, especially at the lower rungs of the economic scale, continue to struggle because housing prices, shelter costs are still going up more than other areas of the economy. And that's not healthy. Hopefully that turns around. So that's the quick summary on where we are on the inflation front. So related to that is the Federal Reserve last week met and decided not to raise interest rates. That is the first time they opted not to raise interest rates since January of 2022. I think they raised interest rates 10 straight meetings in a row. So the benchmark interest rate stays at that 5 to 5.25% range. What they did imply is that before the end of the year, you should expect 2 more interest rate hikes. That remains to be seen. Candidly, I'm skeptical. I'm skeptical that it'll actually play out this way. We'll have to wait and see. I'll report to you on the show. And if you're a client in communication with the office, we'll keep you apprised of our thoughts and what the Fed ultimately does. But I'll tell you, as of right now, having digested this most recent Federal Reserve meeting where they decided not to raise interest rates, I'm not convinced we're going to have more rate hikes this year. I could be wrong. I also might change my opinion. But as I sit here today, I am skeptical. I'll throw a quote out to you. Chairman Powell, Jerome Powell, said, "Inflation pressures continue to run high." I think that's fair, but I think it's also fair to point out that interest rate hikes, depending on who you ask, it might take 8-10 months for them to make their way into the economy and really have an impact. So I think that there's a chance that a lot of the interest rate hikes that were done in the past haven't really fully made their way through the economy just yet. And maybe, just maybe, inflation will continue to fall because of that, as well as other issues like supply chain and getting farther from the pandemic, that maybe inflation will continue to come down and the Fed will back off. I'll also say, part of me thinks that maybe the Federal Reserve is trying to what's called jawbone, basically talk the market into acting the way that it wants to without actually doing it. Almost the threat of making interest rate hikes in the future might get the behavior that they're seeking, which is a little bit of a slowing economy, a little weaker job market, so that prices come in anticipating what the Fed might do. So maybe the Fed can get what they want just by talking about the threat of raising interest rates without actually having to do it. That seems pretty plausible to me. Again, as I said a few moments ago, we'll have to wait and see. Interesting, as we begin to finish up here, I know this is a short episode this week, is that next year in 2024, the expectations is for interest rates to be 1% lower. So what is being forecasted is more rises in interest rates by the end of this year, followed by reduction in interest rates, where the Fed might be cutting in early 2024, which seems kind of wild. Not sure how that'll play out either. There's so many variables, so many balls in the air, if you will. But this is something that's really important. The markets, if you look at major stock market indexes, have had a good year, notably the S&P 500 and the NASDAQ. I think there's a chance, not a guarantee, of course. I think there's a chance, though, a good chance, that the markets continue to rally and finish the year higher than they are today. And a big part of that might be because of the increasingly good news on inflation. The trend is your friend. Inflation is coming down, combined with maybe the Fed being closer to the end of their interest rate cycle, if not actually at the end of the cycle. So I've repeated this a few times. We'll have to wait and see, but so far so good. Thanks for listening to today's episode. I mentioned the work we do here at Elliott Wealth Management, doing financial planning, investment planning for our clients. Please go to our website, elliottwealth.com. Find out more information about the work we do for our clients. You could sign up for a complimentary consultation if you'd like to speak with us personally. We would love that. Lastly, I would love it if you subscribe to the podcast. If you haven't done so already, recommend it to a friend. I'll be back with you on the next episode of the Simply Financial podcast very soon. Thanks for listening today.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.